The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alasdair MacLeod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alasdair MacLeod of Gold Money, and with me on the line from California, I'm pleased to say I've got Charles Hugh Smith, who runs a blog of twomines.com. And he's rated as number 7 in CNBC's top alternative financial sites. He's also a very prolific contributor to Zero Hedge, and he's an author who I think last year published 2 books. That's really going some, and has written novels. How he finds time to do it all, I really don't know. Anyway, welcome to this podcast, Charles.
Thank you very much, and I'm glad to be here with you, Alasdair.
Well, it's an opportunity, really, I think, to look at what's going on in various parts of the world from essentially an Austrian economic point of view. And I suppose what's really on everybody's mind at the moment is the mess that is evolving in Cyprus. How much are you aware of this from however many thousand miles away you are from Cyprus? It must be a good 10,000 miles, I should think.
Yes, despite the distance, like many other people, I'm intensely interested in the shockwaves that are reverberating from the events in Cyprus. Everything from rumors of Russian bailouts to threats that to kick them out of the Eurozone. My first 2 responses are I'm really rather tired of this blackmail, which is the EU's basic modus operandi. Is when any problems arise in their periphery, they instantly threaten them with ejection from the Eurozone or from the Euro. And this confounds me because I would think the people would be cheering at the option of exiting the Euro and restoring the credibility of their economy, and instead of being drained and bled dry to pay the banksters and the bondholders.
Well, I think the problem is slightly more difficult than that, because this is one of these very few jurisdictions where the banks are almost entirely financed by depositors. So the international banking ties are less in the case of Cyprus than they are anywhere else. And this arguably makes it possible for the ECB to turn around and say, well, you got a problem, you solve it yourself. We're not interested. And I suspect that's probably what they're doing. I would also take your point about the arrogance, if you like. I don't think that was quite the word you used, but certainly there is, if you like, a sort of an arrogance at the top, which Cyprus has had to bear. And what's interesting is the relationship with Russia, because Russia also supplies gas to Germany. And I wonder whether their heating bills next winter are going to rise, perhaps more than they might otherwise.
Yeah, the whole aspect of Russian depositors and the rumors that it's oligarchs with tens of billions of dollars in Cyprus banks. All of that could be true. I'm in no position to say whether it is or not, but I think it raises a lot of grand geopolitical strategy games, because apparently there's a lot of there's a potential for oil offshore within Cyprus's claims, and of course everyone would be interested in that. And the U.S. is officially not really responding very much, but we can anticipate that they're interested in keeping, say, the British base on Cyprus active, and perhaps limiting the Russian access to that oil and gas.
I think that's a very good point, because nobody so far seems to be mentioning the very extensive military presence that the British have there. I mean, they use it as an air base. Also, it's a good naval base for that end of the Mediterranean. And I think the Russians have got facilities in Syria, which they must be getting a bit worried about. So, I had the sort of thought that perhaps the conversations in Moscow could be about, well, can we do a deal over access to naval facilities and we kick out NATO? But it doesn't seem to have quite gone that way.
Yes, it's possible that hardball is being played at a level that we're not privy to. For example, just as a speculation, since the Russians are over the barrel, potentially losing tens of billions of dollars in deposits, then perhaps there's a game being played where Russia is being encouraged, in quotes, to proffer a huge bailout in order to keep what they have, as opposed to like getting anything more.
Yes. It's a difficult one to know, Charles. I really don't know. I suspect that there is actually, as you say, a bigger game, because if you actually think about what Cyprus is, it is a tax. No, not a tax. It's an offshore financial center, I think is the correct description, with advantageous tax treaties between the rest of the world and Russia. The result is that it's not just banking business that is in Cyprus. There is an awful lot of economic structures, vehicles, and all the rest of it. And while there may well be, I think they talk about 20 billion euros deposited in the Cypriot banks, there are far larger financial structures actually involved. And I suspect there's a conflict here as well, because while undoubtedly bank deposits are covered by local law, these financial structures are typically covered by English law. So the legal ramifications of what's happening in Cyprus, potentially to Russian money, could actually reverberate far and wide.
I think that's an excellent point, Alasdair, and because there is still a rule of law. It may be bifurcated, one for the elite and one for the rest of us, but nonetheless, there is still a rule of law that will work its way through this. Another issue which has received a lot of attention is, of course, the question is whether the how do we call it, expropriation of deposits is setting a global, should we call it an experiment as to whether this will save the system, or is it setting a new benchmark for official responses to banking crises?
Well, that is an interesting point, Charles. I think people, in looking at this, overlook one fact, and that is that the money on deposit is not the property of the depositors. It is actually the property of the bank. So presumably any law which seeks to tax those deposits has to incorporate the ability of the banks to pass that on to depositors. So essentially, it's the banks that are being taxed, not the depositors. I suppose it is possible for the depositors to be taxed, if you like, by deduction of their liability in the banks. But I still think that the legal basis is actually a bit more complex than people think. And it all arises because they're trying to do deals. I mean, the answer is the whole of the banking system in Cyprus is bust. It's actually no more complicated than that. What should happen is those banks should be liquidated. And in a liquidation, there is a pecking order in terms of, who comes before who. But they're not doing that. They're trying to fiddle something through. And one asks the question, are they likely to succeed? I think the answer is not clear-cut at all. And there is a secondary question. When are these banks going to reopen? And following that, when they reopen, how much of the deposits are actually going to remain in the banks? And I think the answer is most of it would just want to get the hell out of it.
Right. And so let me ask you, is this potentially setting a precedent for the liquidation of banks in the other troubled European countries such as Greece and Spain?
I think in a funny way, the precedent has been partly set by Spain already with Bankia, which just in case our listeners don't know, Bankia was formed out of 7 of the major cajas, the mortgage banks, And all the depositors were transferred over. And as part of the deal, they ended up with equity. And now the equity is worthless. So, it's fiddling around with depositors' rights is not a new experience. And I suspect that to call this a precedent is not quite right. I think to call it something that we should be alarmed about, yes, I think that is true. And that rather brings us into, well, what else do you do? I mean, you've got to get your money out of the banking system, basically, to avoid this sort of thing happening. And I suspect that that's the message going to Europeans more widely, and more importantly to the Russians, whose taste of Western banking, I think, is rather sour.
Yeah, well put. My sources who are familiar with Russia, not so much its financial system, but its culture, tell me that the glass jar bank, which is secreted in the backyard, or
Yes.
the equivalent of the cash under the mattress, is still a very popular form of banking in the Eastern Bloc, because of the deep suspicion of banks in general, which apparently you may have much more specific knowledge than I do, but apparently bank failures are rather routine in the new Russia over the past 20 years. It's not an uncommon thing for a bank to just simply close its doors and collapse.
Yeah, I have no specific knowledge, Charles, but I think what we can say is that with the lack of property rights and everything else that seems to happen in Russia, the crime at a highest level, it's quite difficult, I think, for anyone to trust anything there.
Well, I would be very curious about your opinion about that exact subject, a loss of faith in the structure or the financial infrastructure. Could that be bleeding over in the West? And as you say, the Europeans are wondering, and I think the rest of the world is too. There was a whole flurry of stories coming out of New Zealand that the New Zealanders, I guess, believed that their deposits were safer than they actually were in terms of like legal guarantees. I mean, so this sort of like erosion of trust in the system. Do you think that's real, and what could the consequences of that be?
Well, I think it must be real. It makes sense that people start worrying about these things a bit. I don't think that the man in the street is necessarily immediately thinking that, well, what's going on in Cyprus is going to come here soon. But as this situation develops, I mean, surely people must think about that, and I think they must also consider the status of their money held in banks in one way or another. And that, to me, is going to be the big question. And if they actually think that through, then presumably they're going to start thinking about alternatives, not only to keeping money in banks, but alternatives to paper currency itself. And at that stage, we may get more of a wider interest developing in gold and silver. I mean, do you think that's a possibility in America?
Definitely. It's certainly a strange phenomenon that gold, the general sense that gold is a worthy alternative has taken a hit, in the sense of the price of gold has declined, and general interest in owning it seems to have declined a bit as well. But I think what would really kickstart interest in gold and other precious metals would be a currency that was backed by these, and would be quite a bit more liquid than the actual precious metals or shares in exchange traded funds and so on. And a lot of people have speculated that China is perhaps pursuing a gold-backed currency. And I've often speculated on my blog that actually a very large ETF such as GLD, with a large holding of gold, is actually well placed to issue its own non-state currency. And I realize that would be very that's an outlier in the current financial system. But one does wonder, why couldn't we have a private currency backed by gold?
Well, that is a good question. I think I would like to leave that one hanging in the air slightly, because we could talk about that one all day. What really does interest me is, why is it that the United States is printing $85 billion every month? Simple question, which might require you to give us a rather long answer. I don't know.
I think that there's several parts to the answer. One is that to maintain the status quo in a declining economy and declining tax revenues, then the easiest way to fund the government and everything the government funds is to print money.
Right.
And to give it to the government. And so since the U.S., the Treasury does not actually create the money, the Federal Reserve does, then the mechanism of transferring cash to the government to just spend as it sees fit is for the government to issue bonds, debt, and then for the Federal Reserve to buy it. And of course, it just prints money and then buys the bonds. And so this is effectively just handing cash to the government to spend. And so in this sense, it's propping up a lot of things that people value. They still want their pension checks and they want their Medicare and so on. And so that it's part of the whole propping up of the status quo, as inefficient as it might be. And then the second factor is that a lot of wealth was destroyed in the U.S. in the collapse of the housing bubble. And so in a way, the Federal Reserve printing money and is simply replacing money that was lost.
Right. So if coming back to the government and the status quo, so the government has got these obligations to its electorate, which it wants to continue to discharge. In other words, it doesn't want to cut its spending. So it's relying on the Fed to produce the money so the Treasury can issue some bonds, and the Fed buys those bonds. And in the process, it keeps the interest rate extremely low. In fact, it keeps it well below where arguably it would otherwise be if this intervention didn't take place. What happens when interest rates rise, which inevitably they must do at some stage?
Right. And that's a question that a lot of people are asking, including our friend Chris Martenson, is how long can they suppress interest rates? And basically they've eliminated market forces, discovery. The market tends to discover the price of risk and assets and the value of income streams. And that, of course, is completely suppressed when you have a buyer who will buy the bonds in unlimited quantities. Like the Federal Reserve.
I hate to say this, but the last person who really eliminated market forces was Lenin.
And a lot of people are drawing that parallel.
Right, okay.
Yeah, because of course we both know what happens is, as is being proven yet again in Venezuela and Argentina, you don't really suppress market forces. You simply drive them into the black economy or the underground economy or the informal economy, where the price of risk and assets is priced in gold, in the price of gold, and in the price of more stable currencies like the dollar. But I think we have to ask, why can't the Federal Reserve simply balloon its balance sheet from $3 trillion to $30 trillion? Why couldn't it just print another $30 trillion and keep the game going? And I think this is a legitimate question because there's certainly parallels to Japan, which is not quite, but in some ways played this game for over 20 years now.
Yeah, and look where it's got to now. I mean,
right.
But I mean, that implies that they can continue to do this for a long time. But surely the limit on this is how long does it take before the effect moves from puffing up asset bubbles, which is essentially what's been happening with bond prices, stock prices, property prices. I mean, any asset price you like, and that moves over towards, if you like, the goods and services, the food, the energy, and the things that we actually need to buy to sustain ourselves.
Yes, I think that pathway you just described is absolutely correct, and that the way I see the game falling apart is the asset bubbles and the property bubbles that the Fed has inflated will collapse, as all bubbles do. And then all that hot money will be flowing to commodities. And that will be, of course, gold, oil, grain, all, the things that people absolutely need. And then you get a bit of inflation, which at this point, even a bit of inflation will push the status quo over the edge, because people cannot afford to pay, 10, 20% more. And I think that the real dynamic at work is the political trust and faith in the Federal Reserve and the European Central Bank and the Bank of Japan will be eroded, and that will take away their leeway, if you will, to keep playing this game. People will lose faith in them.
That, I think, makes sense. Let's look at the mechanism whereby if you like, the creation of artificially high prices moves from assets to goods and services. Assets, that's fine. That's easy to understand. Money can flow into and flow out of that. And indeed, most of the money that has been created since the banking crisis seems to have flowed into financial assets rather than the basic economy. Because if it had gone into the basic economy, GDP would have expanded because it's a money total. I think it's as simple as that. But do you think that the variability in the purchasing power of paper money, which after all is totally confidence, so the cost of producing it is zero, do you think that can vary independently from the flows it's not independently, let's say, from a mechanical flow equivalent from assets to goods and services? I mean, it would imply that, if let's say $100 billion was to flow out of one pot into another, the price effect would be quantifiable. Do you think that is the way it should be looked at? Or is there this sort of, a loss of confidence factor which could actually accelerate prices upwards quite quickly in a way in which nobody foresees? A sort of stagflation, if you like.
Yeah, I think you've defined or described two mechanisms, and I think they're both quite active. That the first mechanism, let's start with the fact that most of this newly printed money is flowing to the top 10% around the world, or to some degree the top 1%, which of course has all the wealth, or the majority of the wealth, and of course they are using this extra money or this liquidity that they can borrow very cheaply, and they're the ones who are buying property, gold, and other assets, and creating these asset bubbles. The bottom 90% have very minimal participation in this, and that's one reason why these bubbles are not in the money is not entering the real economy, because most people aren't able to participate in equity and bond bubbles, except marginally through their pensions and so on, which they may or may not be receiving for decades to come. So in terms of the loss of faith, I think that it's definitely a factor, and I wonder, since we're discussing the Eurozone, if there's I see some erosion in the faith of the euro, however marginal at this point, and that could cause a sort of run, if you will, on the euro, and a move to so-called safe havens, which include bank accounts in Singapore, to some degree the U.S. dollar, and as a currency, and of course precious metals, and of course that may also be why real estate is why there's so much foreign money flooding into condominiums in Florida.
Yeah, I think, Charles, that's an interesting point, because really, I think what we're moving on to is a debate about the relative position of one fiat currency against another. Some people have characterized this as a race to the bottom, if you like. Another way of looking at it, which is my preferred way of looking at it, is that perhaps through the Bank of International Settlements, the major central banks have tried to agree on stability between currencies as much as possible, so that, if you like, the effect of all this printing isn't noticed in any particular place. And what's going on in America is also going on with the euro and the ECB. It's also going on in Japan. I mean, spectacularly now. They're getting ahead of the game with their printing presses. And also the UK with her quantitative easing. Is that how you see it? As sort of, they're trying to sort of engineer a stability by all printing at the same time so that none of us actually notice?
Yeah, I think that's an excellent appraisal. And we could put it a slightly different way and say, why wouldn't they do this? Because the alternative would be risking the outright currency war that everyone fears. An interesting question I have for you is China, because China is also expanding its balance sheets and creating a tremendous amount of money and a tremendous amount of credit, much of which is flowing into their property sector. But they also have this link. Their currency is, of course, linked to the U.S. dollar, so it's not a free-floating currency, the renminbi. So they're in kind of a peculiar circumstance, and I don't see too many people commenting on China. And I think they're peculiar because they are creating a tremendous amount of credit and money, which is starting to spark inflation in their economy, and yet their currency trades within a very narrow band, being linked to the dollar.
Yeah.
Do you have any insight into how China's getting away with their massive printing and credit expansion?
Insight is too strong a word, but I think there are a few differences that we can note. One is the different savings rate in China. The savings rate in China, I'm led to believe, is somewhere between 30 and 45%. It is huge.
Yes.
On top of that, China, as you rightly say, has created a credit bubble. But I think it means that when the bubble ultimately deflates, people will have something left over, which I can't say is something I can say happily about the UK, Europe, or indeed America. So I think that's the fundamental difference. I think there is another difference, and that is that the central planners in China, I think, are deliberately going to move from an emphasis on exporting to the rest of the world to developing a domestic Asian market, which will include everything up as far as the Persian Gulf and include Russia. So it's that, there is a sort of they've got a game plan, they've got an exit to what they're trying to do. They've made a lot of the errors which the rest of us have. But perhaps they might not pay for it at the end of the day quite so dramatically as we will, because the way we're going, we're destroying our paper currencies entirely. That's the logical conclusion of all this money printing. China, she's bought a lot of gold. She hasn't told us how much, but we do know that she's been in the market buying gold. And interestingly, she's allowed her own citizens to buy gold, competing in a sense with the central bank and perhaps the Communist Party, which may be holding a lot of the gold. And that's an interesting one, because the way we would do it in the West is we would try and clear the way for our central bank, our government, to acquire gold from elsewhere by prohibiting our own citizens from doing the same thing. But in China, they haven't. I think that shows a degree of confidence in what they're doing.
I think that's true, and I also think it's the party leadership realizing that the average household, the middle-class household, which does save a tremendous amount of money, as you said, has very few alternatives. The Chinese stock market is rightly viewed with suspicion in China, and after you've already bought one or two or three other properties, which people do in China, many people have one or two extra apartments as investments. What else can you do with your savings? And so owning gold is the party leadership's preferred alternative, because they know that there's actual real value there, and they are concerned about their property bubble. So I think it's almost like a wise investment perception on their part to try to funnel all their private savings into something that will not lose value like real estate can.
Yes, I think that's got to be right. But it also raises the question as to why are they still intervening to keep... I mean, obviously they're intervening with the dollar to keep the dollar down against... keep the renminbi down against the dollar. But with over $1 trillion worth of treasuries, there must be big pressure on the Chinese to continue to recycle that into gold and silver, well, particularly gold. Do you think that's a reasonable sort of conclusion to come to.
Yes, I think that, and also that they may well be seeking enough gold to eventually back their currency when it free floats, because they are obviously very concerned about having their currency manipulated when it does free float. And I think it also explains why they're very keen on buying real estate in the U.S., which they also see as something that has real value. And so you'll see a lot of individual Chinese investors snapping up homes for cash, and you'll see Chinese companies buying large blocks of land in industrial wastelands and places that are shunned by American investors, but which the Chinese see as potentially valuable. So yeah, absolutely, everybody wants to get out of paper,
Yes.
and for obvious reasons. But I'm a bit of a outlier in the sense that I think that ultimately, because of it still has the backing of the printing press and some other advantages, the U.S. dollar could rise just as the best of the worst, if you will, while gold also rises. A lot of people think that the U.S. dollar and gold are on some sort of seesaw, and they are on that kind of seesaw where one goes up, the other goes down. But I don't see any particularly fundamental reason why they can't both rise in a real global credit crisis.
Yes, I think I can understand that point, because if you look at the makeup of the dollar index, it's about 49% euro or something. There's a big yen element, and there's a little bit of sterling, and I suppose the various other bits and pieces that make it up. Now, obviously, if the euro goes down, the dollar goes up. And so you can see that the problems, the weakness we've got in the euro at the moment leads to a strong dollar. What they're doing in Japan, you're a lot closer to Japan than we are. You're about halfway between us, I think. But the Japanese have announced they're going over. They're no longer going to rely effectively on borrowing money in the markets. They're going to print it to fund the government deficit. They don't quite put it like that, but that's actually what it is. And they've now got trade deficits. There was a time when people thought the trade deficit was a result of the nuclear explosion they had in the wake of the tsunami, but actually, you only get a trade deficit if the government prints the difference, and that's basically, I think, what's happened there. So your point about the dollar, I think, is absolutely right. The price of the dollar against other currencies is a reflection of its relationship with those currencies. It's not a reflection of its relationship with gold. I think it's as simple as that.
Right.
So anyway, I think if we can, we've had a very interesting time, certainly as far as I'm concerned, and I'm sure as far as our listeners are concerned. So I would like to just finish this off by reminding our listeners that Charles Hugh Smith has a very good blog called Of Two Minds, and you should visit it. And also he's got some books which are very entertaining and should be bought. Charles, thank you very much indeed for taking part in this podcast.
Thank you very much for the invitation. I enjoyed it.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.